Are you prepared for what could be the biggest wealth transfer in modern history? Right now, while you're listening to this, there are seismic shifts happening in our financial system that most people won't see coming until it's too late. I'm talking about changes to interest rates, currency values, and market structures that only happen once every few decades. The ones who recognize these patterns early will be the ones who come out ahead, while everyone else scrambles to figure out what just happened. Today, we're diving into the financial reset that's already begun, why traditional wealth protection strategies might hurt you during this transition, and the specific moves you need to make before the window closes. In this episode, you'll learn 3 wealth decision principles to remember to become smarter with money and an action plan to help you make better wealth decisions starting today. Last month, I sat down with a couple in their mid 50s. Let's call them Mark and Jennifer. They'd done everything right, saved diligently, maxed out their 401ks, and built a portfolio of index funds. But when we reviewed their situation, Mark looked at me and said something that stuck with me. Brian, I feel like the rules of money have changed, but nobody told us. And you know what? He's absolutely right. See, Mark and Jennifer built their wealth strategy based upon a financial environment that's disappearing slowly. Low interest rates for over a decade, predictable market patterns, a dollar that functioned a certain way globally, but those conditions are shifting fast. When I talk about a financial reset, I'm not referring to some conspiracy theory. I'm talking about the natural cycle that happens when debt levels become unsustainable, when currency systems need recalibration, and when entire investment paradigms shift. It happened in the 1970s with the end of the gold standard, happened in 2008 with the financial crisis. And the warning signs are flashing again. And that's what we're going to talk about today. This is Brian. I'm the founder of Momentous Wealth Advisors and the author of Momentous Decisions 7 Steps to Better Health, More Wealth, and a Richer Life. And my goal is to help over 250,000 people in the Twin Cities and beyond make better wealth decisions. So let me break down the 3 major forces driving this reset and why understanding them is the difference between protecting your wealth and watching it erode away. Force number 1 is the debt supercycle. We're sitting on more global debt than at any other point in human history. The US national debt alone has crossed over 35 trillion. But here's what matters for your money. When debt gets this high, governments have only 3 options: default, inflate it away, or restructure the system. Now, governments don't want to default if they could avoid it. So what do? They make dollars less valuable through inflation, which is exactly what we've been experiencing. Your savings account isn't really losing value because of bad management. It's losing value by design. And force number 2 is the currency reset. For the past 50 years, the US dollar has been the world's reserve currency. But that dominance, it's being challenged. Countries are diversifying away from dollars, creating alternative payment systems, and accumulating hard assets like gold at rates we haven't seen in decades. China has been buying gold as well as other countries for the past 2 years. So, what does this mean for you? If the dollar weakens significantly, everything imported becomes more expensive. Your purchasing power drops. And traditional 60/40 portfolio strategies, they were built for a different era. Force number 3 is the generational wealth transfer. Over the next 20 years, baby boomers will transfer an estimated 84 trillion to the younger generations. And that's not just money changing hands from one hand to the other. That's money moving from one set of values to another, from one asset class to others. Real estate, stocks, even what we consider safe investments will have to be repriced. Now, I know what you're thinking. Brian, this sounds overwhelming, a little dark and gloomy. So, what am I supposed to do? Stay with me because this is where it gets interesting. In just a few minutes, I'm going to share the exact allocation strategy that's working in this environment. But first, you need to understand why your current approach might be setting you up for failure. A quick reminder, if you haven't subscribed yet, hit the button now because by the end of this video, you'll have a step-by-step action plan that will position your wealth to survive and thrive through this transition. So let's talk about what's not working anymore because this might challenge some beliefs you've held for years. Number 1 is the set it and forget it myth. For decades, we've been told to put money in index funds and don't touch it. And look, that's not terrible advice in a stable, low interest rate environment with predictable inflation. But we're not in that world anymore. When inflation runs hot, cash and bonds get killed. When interest rates spike, traditional balanced portfolios take hits from both sides. The set it and forget it approach assumes tomorrow looks like yesterday, and that's a dangerous assumption right now. I'm wondering if you've kind of felt this tension in your portfolio. There's a lot of tension in the world right now, but maybe not because you feel wealthier, because stocks are at all time highs. But let me know in the comments. I'm genuinely curious how many of you are maybe rethinking your strategy. I'll be giving away 5 complimentary portfolio reviews to the first 5 people who make a comment with the answer to this question. And type the word portfolio in your comment. So this leads me to wealth decision principle number 1. The best defense is positioning, not prediction. You don't need to predict exactly when and how this reset happens. You need to position yourself so that you're protected regardless of the specific outcome. Think of it like wearing a seatbelt. You don't need to know when the accident will happen. You just need to know you should buckle up. For example, instead of trying to time the market crash, you position with assets that perform differently in different environments. Some assets do well in inflation, others in deflation. Some thrive when the dollar weakens, others when the dollar strengthens. Positioning beats prediction every single time. Now, I've never told a client to get completely out of the market, and I'm not doing that today. Moving to cash is not a great idea. That doesn't mean you shouldn't raise some cash or rethink your strategy. But if you put it in a traditional savings account, it's full of holes. Savings accounts are at 0.5% interest when inflation is running at 3 to 4. That's a guaranteed loss of purchasing power. Bonds that seem safe are now vulnerable to interest rate changes. Even treasury bills, long considered the safest investment, barely keep pace with real inflation when you account for taxes. The concept of risk-free investing needs to be kind of retired. There's no such thing anymore. There's only different types of risk. Now, I'm about to reveal the 3 asset categories you need to be paying attention to right now. But there's one category that might surprise you because it goes against conventional advice. So let's talk about a protection strategy, the actual moves that you could possibly make. Number 1 is real assets. During times of currency uncertainty and inflation, real assets, things with tangible value, become critical. I'm talking about commodities, precious metals, real estate, and even collectibles. These are assets that don't depend on government promises or corporate earnings to hold value. Gold, for instance, has been used as money for 5,000 years, not because it's perfect, but because it can't be printed into existence. When Mark and Jennifer came back for our second meeting, we shifted 10% of their portfolio into precious metals, not as speculation, but as insurance. We also increased their international and emerging market exposure because of valuations and the dollar weakening. So here's our second wealth decision principle. Value flows to scarcity, not promises. During a financial reset, the assets that hold up best are the ones that are genuinely scarce. Bitcoin has 21 million coins, period. Gold is limited by geology. Prime real estate in desirable locations is finite. Meanwhile, government bonds and currency can be created with a keystroke. This doesn't mean you dump everything into gold bars and put them in a safe or go out and put 50% of your portfolio in a gold ETF. It means you respect the principle of scarcity in your allocation decisions. Number 2 is productive assets. This is where it gets nuanced. While I'm cautious about overexposure to traditional U.S. growth stocks, I'm bullish on productive assets. Businesses that generate real cash flow, own hard assets, provide essential services. Think energy companies, infrastructure, or agricultural operations. These businesses don't just hold value, they create it. During the 1970s inflationary period, energy stocks were one of the bright spots. And number 3 is optionality. This is the one that surprises people. You need liquid capital, dry powder to take advantage of opportunities when they arise. Every reset creates distortions. Assets get mispriced. Opportunities emerge for those that are ready. Having 5 to 15% of your portfolio in a high yield savings account or money market isn't being overly conservative. It's maintaining strategic flexibility. So, a quick question for you, and I'd love if you replied to my pinned comment on this. What percentage of your portfolio is in assets that would actually benefit from inflation or currency weakness? Not what you wish it was, but what is it actually right now? This self awareness is the first step to better positioning. I'll be giving away 5 complimentary portfolio reviews to the first 5 people who make a comment and type the word portfolio. Here's your 5-minute challenge for today, and I'm serious about this. Do this as soon as this episode ends. Pull up your investment statements, all of them, your 401k, your IRA, your brokerage account, whatever you've got, and answer these 3 questions. Number 1, how much of my portfolio is in cash or bonds that are losing to inflation? Number 2, what percentage is in assets that historically perform well during currency instability? Real assets, precious metals, certain commodities, possibly even Bitcoin. And number 3, if inflation stays elevated for the next 5 years, which of my holdings would actually benefit? Just this simple audit will tell you how exposed you are. Most people discover they're way more vulnerable than they realize. And this leads me to wealth decision principle number 3. Preparation is profitable. Panic is expensive. Think about every financial crisis you've lived through. The people who got hurt the worst were the ones who panicked and made emotional decisions at the worst possible time. They sold at the bottom. They chased hot stocks at the top. They let fear drive the car. The people that come out ahead, they already have done the work. They had a plan. They stayed calm while everyone else was freaking out. Right now, while things still feel relatively stable, is the time to prepare. Not when CNBC is running red banners and your portfolio is down 30%. Right now. For example, if you know you want some exposure to precious metals, you can research, compare options, and enter positions thoughtfully. If you wait in crisis mode, you'll be making decisions based upon fear, paying premium prices, and second guessing everything. Now, before we wrap up, I want to give you the step-by-step action plan I promised. The specific sequence of moves to implement this week. So let's bring this all together with an actual plan. Step number 1, this week, complete the portfolio audit I mentioned. Know where you stand. You can't fix what you don't measure. Step number 2, this month, educate yourself on the asset categories we discussed. You don't need to become an expert, but you should understand the basics of productive assets and how they behave in different economic environments. Step number 3, the next 90 days, make your first positioning moves. This might be reallocating a percentage to precious metals, researching energy or infrastructure stocks, looking at getting more international or emerging market exposure, simply building up that dry powder reserve in a high yield savings account. Start small if you need to, but start. And number 4, review things quarterly. The reset won't happen overnight. It's a process. Check in every 3 months to see if your positioning still makes sense based upon new data. Now, look, I know this episode covered a lot, but here's the truth. The families who build lasting wealth are the ones who will see kind of around the corners. They don't need perfect vision. They just need to be looking in the right direction while everyone else is staring at the rearview mirror. Mark and Jennifer, 6 months after our initial meeting, they've repositioned about 30% of their portfolio. They're sleeping a little better. They feel like they have a plan. And when the headlines start screaming about economic uncertainty, they'll be ready. And you can be too. If this episode gave you a new perspective, do me a favor, hit the like button and subscribe to the channel. I release new episodes every week on wealth strategies that actually work in the real world. Drop a comment and let me know what's your one change you're going to make to your portfolio after listening to this episode. I read every comment, and your insights help shape future episodes. And if you want to go deeper, watch my episode on upgrading your portfolio that walks you through a portfolio positioning strategy step by step. The link is in the description to get your access to my risk number tool. And I'll be giving away 5 portfolio reviews to the first 5 that comment on this episode with the word portfolio. Next week, we're tackling something that's costing families thousands of dollars a year without them even realizing it. The silent wealth killers hidden in your budget. And trust me, you're not going to want to miss this one. Until then, remember, better decisions today, better wealth tomorrow. This is Brian, the Wealth Decisions Guy, and I hope to see you next week.